So many people have positions in securities that have gone up a lot and they don't know what to do because they don't want to have to pay the taxes if they sell. We've got a solution to that problem. It's another way you can make better wealth decisions. Stick around.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
Our guest this week is Winston Robinson. He is the Vice President of Advisor Partnerships and Strategy and Advisor Solutions with Purpose Investments. He helps planning-based advisors and portfolio managers build modern independent practices. And he has over 20 years of experience as an advisor, as a wholesaler, as a practice management leader. And he helps advisors support their clients to find good solutions to some problems that they might otherwise encounter and might not be able to solve. So welcome, Winston. How are you?
I'm doing great, John. Glad to be with you.
One of the things that you do that we've never discussed before on this podcast is that you assist people in dealing with concentration risk, which is a unique problem. It's basically the problem of having done too well, or maybe you inherited some stocks from Aunt Ethel. But at any rate, you've got a large-ish position in your portfolio, and specifically in the taxable portion of your portfolio, that you're going to have some capital gains that you don't necessarily want to trigger. So there's a hidden danger associated with concentration risk, and that is if you've got a lot of money in one thing and that one thing doesn't do well. I'm thinking of what happened with Nortel, 30 years ago or whatever, but people don't want to sell it because it's up so much. And of course, things go down. So you've got a unique solution at your shop. And I'm wondering if you can maybe take a moment to explain to us what it is, how it works, and why people should consider it.
Absolutely. It feels like when we say 30 years, it's a blink of an eye, but that was a real reality for Nortel. And at one point was 1/3 of the size of the total TSX market cap as a whole. And so, these conversations are really important because it's about appreciating that a lot of what we're talking about here is more behavioral than it is financial. And when you see success and continued success, sometimes it comes with a bias that things will continue in that direction. And often that can be true. However, what we want to avoid is having a disposition that takes away from the planning aspects of what matters most for investors' long-term goals, and reducing some of that concentration risk is one of the means of being able to do so. So at Purpose, there's a really unique solution that really helps planning-focused advisors support their clients that might be in these situations. And it's called the in-kind exchange, which is unique to Purpose. And essentially, what it helps to do is mitigate some of the concentration risk that happens as a result of seeing a disproportionate amount of wealth in a single security position that represents now an outsized proportion of the client's overall wealth. And so we end up with a lower cost base, but a significant market value. And in between that is something that we call a taxable situation. Okay. What we help to do is provide optionality. And so through the in-kind exchange, we're able to exchange that single stock position, bring that into the Purpose in-kind fund, and now take that position, maintaining the same ACB as the original position, and have it diversified in an intentional portfolio of Purpose solutions that are designed to meet the objective of the client. Right. So it provides that optionality and tax deferral.
So let me see if I can translate so that the people at home are understanding what that means. You take shares in one company and you put it into the product that you offer. And in exchange, what you take back is a diversified basket of a number of stocks. And so you're getting a lot of diversification, and it's not a taxable event. All you're doing is exchanging shares of one for the other. And the shares in whatever it is, Royal Bank or Enbridge or whatever it is that you are giving up that you didn't want to sell, and it's done really, really well, and it's pick a number, it's a $50,000, $100,000 capital gain that you'd really rather not have to trigger. You can just put some or all of those shares into one product, take a diversified basket out, and have your tax bill be pushed off until some possibly much later date, but at any rate, a later date, so that when you sell, you pay taxes then, but not before.
You got it. You got it.
Yeah. Okay. So you said this is behavioral. And one of the things that I talk about a lot in my book, Bullshift, and in other things in the podcast is how a lot of that is exactly the case, how a lot of decisions that are made with regard to finance are not based on numbers, they're not based on ratios, but rather they're behavioral. We have recency bias, we have status quo bias, and a lot of people will hold off on selling something because they will either A, not want to pay the taxes, but B, because it's gone up recently. And so as a result, I'm going to work on the assumption that the recent past is a prologue of what I might expect in the future, which of course is not necessarily the case. What if you could maybe offer some thoughts about behavioral investing and overcoming these kinds of behavioral blind spots that we are virtually all prone to have to deal with?
It's part of human nature, John. And there are heuristics that are essentially patterns of thought of how people, us human beings, operate. And so the first thing I want to say is that these are natural things. However, the question is whether they're natural or not, is it helpful, right? Is it actually supporting the goals and the plan of the individual? And one of the challenges from a behavioral point of view that we see is overconfidence and familiarity. Especially when you think about this could be applicable to corporate executives or employees that have been long tenured at a firm, getting paid in stock options or taking advantage of share purchase plans. And now they're working on the inside. So, who knows the company better than them? They sat at the quarterly meeting and see what's going on, and not to suggest insider trading, but a sense of comfort and familiarity sometimes creates a false comfort in the sense where it may lead an investor to have too much concentration in that single stock and too much comfort to be thinking about the risk management side of that equation. And when the studies that you read about returns and return dispersion, we see that it's generally a relatively small minority of stocks relative to the size of the overall makeup of the index that really drive an outsized proportion of those returns. Well, it's a wonderful thing when you can be in that short list. But it's also a temporary thing that history has also shown us. And so it's really important to make sure that we're managing the risk of having exposure to great quality names, but also being able to diversify that amongst a broader approach to capturing market exposure.
Great. So let's see if we can maybe lift up the hood, and I'll ask you to, I don't want you to geek out too much, but maybe just show us a little bit more about the nuts and bolts. How does the program actually work?
Right. So I'll take off my propeller beanie at this moment in time and kind of simplify it. And I think that's really the beauty of how this solution works, is the simplicity. So essentially, clients are taking their position in single stock position with significant unrealized gains. And we think of that at least 100,000 in unrealized gains. We've seen six-figure positions come into this strategy. We've seen 9-figure positions come into this strategy. And so these single stock positions are then exchanged into the fund. So they're contributed to the fund and then exchanged into a diversified basket of purpose solutions that can be customized to fit whatever the needs or objectives are of that particular investor.
Just so that I'm clear, when you say a customized basket of solutions offered by purpose, that means that you might have 4 or 5 different baskets and you can contribute, say, 25% into each of 4 different baskets, so that you're building a diversified portfolio with foreign stocks and domestic stocks and large and small and whatever else, all by just exchanging one a large position in one stock that you have currently. So you can build a diversified portfolio just by giving up one stock and taking the rest back, no taxes until you sell.
You got it. Yeah, that's exactly right. And I'll give you a recent example where we're working with a portfolio manager who had a senior client, over 70 years old, They had invested in NVIDIA and Apple. Spoiler alert, they did well.
Yeah.
Okay, but now 70 plus years old, they don't have the same needs for growth as they once did, but still want exposure. So they were able to exchange that position into a diversified basket of purpose dividend fund and other funds that were more income oriented for the needs of that individual.
But you give me a sense, Winston, of how many different options are there in terms of being able to put the money into. How do you slice and dice? Are there just 4 or 5 options? Are there dozens of options? How many different funds are eligible for this program?
Yeah, so there's quite a spread of options that are available to fit different risk tolerances, time horizons, goals overall. So roughly about 15 different strategies are available for investors to work with their advisors and find out what the appropriate mix would be for their goals.
So let's talk about behavioral modification. This is one of my favorite topics. So much of finance is not intellectual, but it is between your ears, but it's emotional and the way you engage in things. So I'm wondering if there might be a story you can tell about how people have maybe in the past dealt with a big pregnant capital gain that they don't want to trigger, and how you can sort of hopefully take some ease their mind, make them feel better about what they're doing, maybe show them a case study. So maybe, can you maybe tell me a story about maybe some strategic benefits for people who do this?
Yeah, for sure. I mean, this has been around since 2014. Mm-hmm. And so proven, affirmed, and the use cases are numerous. When you look at over that tenure of time, there's been hundreds of millions of exchanges that have been done over time. But where some of the most impactful stories for me that I've heard from other colleagues and other portfolio managers that we've worked with have been around family level optimization. Right?
Okay.
So when you think about families that are doing intergenerational planning, they could be wealthy families, they could be average families, but it tends to be more of a larger, net worth type of scenario in these contexts. But we've seen where families have been able to use the program to support multi-generational planning. Mm-hmm. And whether that's philanthropic strategy, whether that's looking at estate design, whether that's looking at estate-free scenarios where, those a position is taken and frozen for preferred shares and given to the next generation, kind of gifted for them to hold on to and experience the growth and the future tax liability. But now there's concentration risk for that family or benefactor that gifted the funds. And so we've been able to create and support optionality for those individuals to do intergenerational planning so that they know that not only their family is taken care of and they can plan for their future for the next generation, but also that we're managing for their own concentration risk, their own tax liability, and their own liquidity needs as well through the in-kind solution. So that's some of the most impactful stuff around family support and intergenerational planning that we've seen.
Those are the really big numbers. What about the small numbers? Is there ever a pregnant capital gain that you're going to say it's too small? Like someone comes to you and says, I've got a $10,000 gain that I've got from, 1 year of being invested in NVIDIA. Are you going to say, well, that's nice. Come to me when you've got bigger gains, or will you do an exchange even with small capital gains, relatively speaking? Or is that too much of a nuisance for you?
It's one of those balances that in managing a fund and managing a company and thinking about the experience and sustainability for all investors that are there to be mindful of. And so it's democratized in the sense that it could apply to situations where an investor has as little as 50K of an unrealized gain. However, that would be spread across multiple positions. So as I said, the standard is about 100,000 in unrealized gains. And I would say you'd be surprised, but you've seen a lot, John. You've been around a long time. And, it could be it's any stock, it's stocks available on the North American exchange, and that could be at various capitalizations. So we've seen individuals that have put money into wheat stocks that have taken off, and they were glad that during that run up, that they did something about it and diversified it, because things aren't very different where they were today. But even investors that start from humbler beginnings, we see a lot where early stage investors have done very well starting with modest means. And so it's less about, discriminating against the size as much as it is about thinking about sustainability of the program for all, and giving different pathways to be able to access it.
That has me thinking about another variation. What if someone says, I've got $120,000 of capital gains, but it's 4 different stocks. They're all up by $30,000 each. Is that the sort of thing where you can then work with them to say, okay, well, it's $100,000 of present gains that we're trying to defer, but we're taking on 4 different securities, and maybe some securities are better for one product as a basket, and maybe some are better for another. Is that the sort of thing where it works? Or are you going to say, well, no, 50,000 really is the amount that we would like for any one security?
Yeah, I mean, it generally has been in the past the latter. But part of what makes Purpose client-centric and advisor-centric is that we listen. We listen to our advisors. We listen to those that are investing in what we're putting forward. And so we've grown the way we have over the years as a result of being mindful of it, while also being discerning to think about what's the trade-off here. We want to be able to help Canadians succeed in their long-term goals. And we want to be able to do that intentionally and mindfully in a way that is sustainable for all involved.
So it's funny, because one of the things I say over and over on this podcast and in the videos I put out is I tell people, look, are you sure you can handle the risk associated with markets right now? And it's funny that we're having this conversation in the middle of March of 2026, because we now have what seems to be a very large regional war, which may even get bigger before too long. And a lot of people want to take risk off the table. And I'm constantly telling them to take risk off the table because of the various things that could go wrong. I'm not saying they will, but they certainly could. And people who are retired or nearing retirement don't have the opportunities that other people have to buy the dip or to, wait longer for things to come back. So this strikes me as being a really great solution for people who has already experienced a comfortable run-up, and they want to lower risk. And it's not necessarily concentration risk. Stocks and bonds go up and down at different rates, but risk and return are related. And those things that are often the riskiest are also the things that have gone up the most when markets are going well. So if you're trying to take risk off the table, not just necessarily the risk of concentration, but the risk of being in a sector or just being in a market at a top and whatever else, this is a great way to lower risk in general without even worrying about concentration. Obviously, concentration too.
Absolutely, John. And, I think about a study by JP Morgan that was done 2024, and it looked at catastrophic drawdowns, which they defined as companies that had lost at least 70% of their value from peak, right, to trough, and never fully recovered. And what's surprising is that although when we were speaking a moment ago, we're talking about, for that investor that started with modest means and maybe put it into a wheat stock and now it's exploded. Well, the reality of what we see in terms of those catastrophic drawdowns have been in high quality companies that have been well capitalized. If I look at some of the statistics, and I'll share the study with you that maybe you can include in your show notes if people want to be educated. But we see that 54% were profitable, 63% carried low leverage, and most of them held strong buy ratings. And so, to your point, it's not about just the individual stock or the quality of individual stock, because the perception, just like Nortel, is that it could be well capitalized. But the smart thing to do, the balanced things to do, the risk managed thing to do is looking at how do we diversify and take the rewards of the growth that we had, but also protect it at the same time. And that's where the in-kind solution has been super helpful to help investors better diversify some of that risk while managing some significant taxable consequences and deferring those out for more intentional planning.
Perfect. For the people that are listening at home, if you haven't already done so, this is your opportunity to subscribe. I don't ask often enough for people to subscribe, Winston, so I'm going to ask today. If you haven't already subscribed, it would be very much appreciated if you did. We're going to be doing a lot more to add really great content down the road. Today, I want to thank you, Winston, for your time and for your expertise. It's been a real pleasure.
Thanks so much, John. Happy to be here, happy to help. And if anyone would like some support in what they're doing, speak to your advisor, see how they can help, and we're here to support.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.